Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, March 2nd, and then we'll see how things look for Friday, March 3rd. We had a bit of a bounce, not necessarily a surprise. On a positive side, we were able to get back above the 200-day simple moving average, stay above that, and then some comments came out from Fed Governor Bostic, and the market seemed to really like that, and it pushed prices back up higher to help work off some of this short-term oversold condition. But there wasn't an awful lot of strength behind the move. So we'll have to see. Is this the beginning of some kind of a change in trend? Or is it just a bounce working off a short-term oversold condition? We might go up a little higher from here. We might go sideways. Or maybe enough of the oversold condition has been worked off where we resume the downtrend. We do have some positive seasonality for Friday's session, but then it's going to be followed next week by some pretty weak seasonality, and I'll go through that. So let's go back and talk about what happened. Right at the open, we did have a gap lower open. We went below S1. The futures were negative during the night. There wasn't a lot of economic news that came out. The market was negative. It stayed negative after the reports came out. We gapped lower down at S1 at 39.36. Then prices quickly rebounded above the 200-day simple moving average. That could be positive, and that is currently at 39.40. As the day went on, prices chopped sideways after it got above the 200-day simple moving average. We were then able to climb above the end change level. We went above the daily pivot at 39.54, above S1 at 39.69, and got all the way up to S2 at 39.87. Then going into the close, we closed just off of S2. We were up 0.76%, and this is kind of concerning, below average volume. Our technicals are still negative overall, and we're working off some of this short-term oversold condition. We're not seeing an awful lot of evidence that things are really shifting. We didn't have any kind of critical mass to the downside. When we're going back up, we're not seeing an awful lot of conviction. Now, that could always change. If we continue to have updates from here, we'll evaluate things on a day-by-day basis and see if it shifts. But right now, it just looks like a dead cat bounce because of this inflation and interest rate scenario that are producing growth concerns, as well as earnings per share, valuation concerns. We have a lot of geopolitical concerns right now concerning Russia, Ukraine. There's been a lot of increase in some of the rhetoric going back and forth over that. We'll have to see if that escalates things or if things tend to calm down. And then nothing has really been dealt with yet as far as the debt ceiling is concerned. Here's the intraday chart showing how we gapped lower down below S1, and I kept this 200-day simple moving average on here just to give us kind of a guideline on an intraday chart as to what's happening. Where we came down, we set the low right at the open, and then rather quickly we came back above this 200-day simple moving average area, and that's somewhat positive. When some comments came out from Fed Governor Bostic, things finally shot up a little higher. We went above the unchanged level, the daily pivot. We went above R1 all the way up to R2. And then finish down slightly off of R2. What are some comments that we can make? The S&P is still above its 200-day simple moving average, and it's just about at the 50-period simple moving average. So these are some pretty important levels. These are the comments that Atlanta Fed President Bostic said, who will be a voter in 2024. He said that he favors a 25 basis point hike at the upcoming meeting in March. And this was taken as dovish because there's been a lot of talk that maybe they're going to boost rates 50 basis points. Then he's the one yesterday, if you watched yesterday's video, that said that the Fed needs to get to the 5 to 5.25% rate level and then leave it there well into 2024. So what he said yesterday was taken as more hawkish. What he said in Thursday's session was taken as more dovish. On a short-term basis, we still have some of our stochastics that are oversold. Intermediate term, we have one area of our PMO study that's still oversold, and the CCI 20 is just trying to bounce up after being extreme negative. The dollar was up and interest rates were up. Now, this could have provided some headwinds for stocks. If the dollar's going down, that tends to help stocks, and interest rates going down also can help stocks. Well, they were both up in Thursday's session. We still have all of our yield curves that remain inverted. We're just watching those to see if they click back over into no longer being inverted. Sentiment is now down to neutral. We dropped a little bit even on an up day. It had been at 56. Well, after Thursday's session, we closed down at 49, so right at the midpoint. Our trend is still negative. Even with the up day, the red line is still on top and we're below 20, so we are also in a trendless environment. I've changed our bias over to mixed just because I wasn't really convinced by this upward move that we saw. We're going to have to see follow through for things to change back more positive. And I've also changed our momentum over to mixed. We did have an up day, so you have to acknowledge that, but was there real strength behind it? And at this point, it doesn't really look that way. As far as the economic reports that were released, we had the fourth quarter productivity, the revised version. It came in at 1.7%. They expected it to be up 2.5%, so this was less than expected. Last time we had the report, it came up 3%. The unit labor costs, and this is what the market really focuses on, it came in at 3.2%, a lot higher than the 1.4% they had expected. This is showing some potential inflationary signs. The last time this report came out, it was up 1.1%. Weekly jobless claims continue to be weaker, and I have a couple charts to show you. It came in at 190,000. They expected it to come in at 197,000. Last week, it was at 192,000. Here are the weekly jobless claims, showing overall how we are declining in the overall trend. The line that I pay most attention to is the blue line here, which is the 4-week simple moving average. Because these numbers can chop around quite a bit, the moving average helps to smooth out the overall trend. And here are continuous claims, also dropping below the moving average and declining. So this still suggests that the employment situation is pretty strong. Now, one thing to be aware of, the employment report is not coming out in Friday's session. Normally it comes out on the first Friday of the month, but for some reason it was scheduled for next Friday. So just be aware of that. Our Ulcer Index continues to tick up a little bit higher, showing there's a bit of fear coming back into the market. And then for some reason I had another update of the American Association of Individual Investors. They're starting to get extreme negative with their reading. And since we've hit some difficult times, they're reacting to that, and it's producing the sentiment down into an extreme negative reading. Looking at the VIX, we did drop on the up day. We're dropping down below 20 with the line chart, and we're also declining based on the bar chart well below 20, and we closed at the low for the session. The VIX of the VIX also is showing a real decrease in volatility. One chart that finally updated in a timely manner is the equity put call ratio. It declined on the up day, and that's not necessarily surprising. But what we're seeing on our 5-period simple moving average is this is really starting to go up. We're getting to that 0.8 level, which tends to be an extreme positive reading. So when we look at it on this chart, we're not there quite yet, but we're starting to move back up, and we could go above this red line. Sometimes when we top out with the equity put call ratio with a 5-period moving average, that will often mark a low in the S&P and give some support, but we're still not at that level yet. Another thing to be aware of, and one of the reasons why I said Thursday wasn't all that strong, is that growth really underperformed value. Mid caps, it outperformed slightly, but in small caps, it really underperformed. So in a good, strong upward move, we would want to see growth outperform value, and for the most part, that did not happen. These core areas in the middle, these are ETFs. Like here's the SPY, then you have the MDY and the SLY in here. That's why I kind of go over this middle column without saying too much. I'm really focusing on the left or the right-hand side. The ADX still shows that the red line is on top even though it's decreasing, and the green line did turn back up. They haven't crossed yet. Our ADX continues to decline below the moving average and is below 20. So we're still in a trendless environment, but we default to the negative side. The daily chart shows how we came right down to this trend line. So far, this trend line area has been holding up. We dropped a bit below the 200-day moving average, but quickly went back up. As the day went on, we were able to get right back up to the blue line, which is the 50-period moving average. And then down below, you see where volume didn't really pick up. So there's not a lot of conviction behind this move. The stochastics in the short term are no longer extreme negative. They're bouncing up out of that. We're still extreme in the intermediate short term, and we're still declining in the long term. The Stoch RSI bouncing up from being extreme negative, as is the Williams percent R. The Arun indicator still shows that sellers are in control with buyers decreasing, so the oscillator down below is below zero and declining. That is negative. Here's the 50-period moving average study, just showing how we came right back up to the red line, which is the 50-period simple moving average. Here's our moving average tree, showing that we're still down inside of the moving average tree itself, so a lot of these lines are getting kind of jumbled. It's looking more like spaghetti. Chaikin Oscillator turned up slightly, but it's still below zero, so that's negative, but we did see a bit of a bounce. Here's our PMO study. The PMO's rising is no longer extreme negative, but the buy signals continue to be extreme negative, and we're declining with the PMOs that are above zero. The Swinland Trading Oscillator, this could be positive also. We're turning up based on price and volume, and we saw that after Wednesday's session, that did give some support to the market. So will this indicator going back up give additional support to the market? The BPI still is below 50, ticked down just slightly. It didn't really participate in the upward movement we saw in Thursday's session, so this is still negative overall. And our broader measure, by looking at the NYSE bullish percent index, still continues to decline. The Chaikin money flow is declining as well. The bars are still green, which are slightly positive, but you can see this downward sloping moving average shows that we are declining. The balance of power did tick up slightly. We're barely above the dashed line, so that is slightly positive. The TTM squeeze continues to decline with the addition of more red bars. The go, no go is now down to a deep purple, so we're looking at some smoke on the water here. Short-term fib levels, nothing really decided. We still have resistance at 4,007, and then on this chart we have more support at 3908, and we're pretty far away from both of those levels. Although if we do see some more advance, we might run back into this 4,007 level. On a longer-term basis, nothing is really decided. We have another retracement level at the 3998, 3999. You could almost round this up to 4,000. So if the market does continue to show some follow-through strength, we'll be watching that 4,000 level as well. Longer term, nothing really decided. If we do go back up, we're looking at overhead resistance at 4,020. The Elder Impulse system for the S&P 500 continues to be neutral. The McClellan Oscillator, after giving us an extreme negative reading, is now bouncing back up, so it's no longer extreme. And then our wider look at the NYSE McClellan Oscillator shows a little bit of improvement, but we're still below zero, so it's still negative overall. The summation index based on price and volume continued to decline, and volume is below zero. I brought this up in yesterday's video, the Ichimoku cloud, where we might get some support from this green cloud right here. We've come right down to this level, and as we've been moving sideways, we're starting to bump into that cloud. Will that provide some support, or will we end up breaking down below that? New highs, new lows, didn't really see much of an expansion either way, so our 5 period is declining and our 10 period continues to decline. The advanced decline line showed a little bit of improvement above an advancing moving average based on price and volume. The advanced decline ratio turned up slightly but is still below zero, so that's negative overall. We're turning back up slightly with the accumulation distribution and just slightly above the moving average, so that's somewhat positive. Volume didn't really pick up that much, so we're still declining overall. The diamonds are still neutral even with the up day. The Dow was up over 1%. The NASDAQ was able to regain its 50-period moving average, so that's positive. The NASDAQ 100 also regained its 50-period moving average, and the Qs for the NASDAQ 100 are switched back to neutral. Small caps are also neutral. Then looking at our small caps to S&P 500 ratio, small caps are still outperforming the S&P, so that could be positive. The mid caps are also neutral. And the Russell was able to regain a little bit of a support level here. We fell back down. What had been support now becomes resistance. Well, with the Russell 2000 small caps, we were able to regain this. We're turning back up slightly with the RSI, but we're still below 50, and we have a declining MACD on the bottom. Yields really went up. The 10-year yield broke above 4%, so that could be negative overall for the market. And looking at bond prices, we're seeing a real decline where the RSI continues to decline and the MACD is also negative. An update with our possible positive scenarios. Because the small caps are outperforming, this red line is spiking up, which could provide some support to the market. And the S&P to utilities ratio, after spiking up slightly, just declined a little bit. But this is also going up overall and could give some support to the S&P 500. With the rise in interest rates, we've taken out this spike now, and we're just waiting to see where will this top out before it starts to come down and possibly give some support to the market. And the staples ratio to the S&P 500, after giving us a spike, really fell down, started to come back up, but decreased just slightly. So what's our outlook for Friday? The technicals are negative, and right now it just looks like we're working off a short-term oversold condition. If we have a down day on Friday, we're going to go right back into that oversold condition. If we go sideways to slightly higher, we could continue to work off this condition. If we really move to the upside, then we'll just fall back and regroup and see, are things actually changing? It doesn't look that way right now. We can only go with what our charts are telling us right now. That's why we fall back and regroup and evaluate things at the end of each day. We do have the IHS Market Services PMI. The final report will be coming out. And the big one will be the ISM Services PMI. And then the whole list of geopolitical events, with inflation and interest rates being the real concern of the markets. Then looking at the Fed speak schedule, we did have a speech on Thursday, which really didn't seem to have that much of an impact. We'll have another speech at 3 p.m. on Friday by Governor Michelle Bowman. And then looking at the Stock Traders Almanac, I'm just going to go through the statistics for March 3rd. The Dow is neutral to positive. The S&P is positive, up 61.9% of the time. And the NASDAQ is the same as the Dow at neutral to positive. And then I'm just going to click through this pretty quickly to avoid the video from becoming too long. Please feel free to stop this and look this over. I do go over this from time to time. I've tried to add this little box in here to the 21-year look at the markets, where going from the second trading day to the third trading day, we do see a bit of a bounce here. So that is somewhat positive. But then after that, going into next week, we see some weakness. One mistake that's on this chart is it says non-farm payrolls on 3/3. That's not correct. It'll be next Friday's session. So when we're going through March, we'll see some weakness, and then about the middle of the month, we start to see things improve from there. This also shows that same basic idea. Here is the box where we're at. We're looking at the green line, which is a pre-election year, which is what we're in after a midterm bear, which is what happened. And this is historically what has happened for the S&P. And then we continue to be in that general sweet spot for stocks right now. So there is some real positive seasonality. We just need to see our technicals turn back more positive, see a pickup in volume, and see things turn a lot more positive. Our scenarios can't really go with the down one now because we're not trending and we're possibly just working off this short-term oversold condition. Can't go with the up one because we are negative overall. So we're continuing to go with the sideways trend with the ADX that is weakening and below 20, and the red line is still on top, so it is negative. Our conclusion, the S&P is negative, but working off this short-term oversold condition. It's still slightly oversold in the short term, a little bit oversold in the intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I will look at preparing the daily video, the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video over the weekend. It's a pretty heavy haul, so I'll do my best to get those prepared and posted just as quick as possible. So I will talk to you in the next video.